20% of the world's oil supply was just, well, choked off. The Strait of Hormuz is actively being mined right now. I mean, by all traditional laws of financial gravity, global risk markets should be in absolute free fall today.
Oh, totally.
We should be looking at red screens across the board. But the strangest thing is happening, you know? Bitcoin and the broader digital asset markets they are barely flinching. In fact, they're holding their ground and in some areas even showing slight upward momentum.
It is a massive contradiction. What we are seeing today completely defies the fundamental risk models that Wall Street has relied on for decades. I mean, fear on this scale usually forces an immediate, just brutal liquidation of speculative assets.
Right, which brings us to why we're here today. Welcome to the Deep Dive. Our mission today is to decode this bizarre anomaly taking place right now on April 9th, 2026. We are looking at a market suspended between two massive opposing forces.
Yeah, it's a wild setup.
On one side, you have this extreme geopolitical terror in the Middle East, and on the other side, crashing head-on into that terror is an unprecedented and nearly silent wave of legacy wealth integration happening right here in the United States.
Exactly. And, the answer to why the market isn't crashing isn't found in the Middle East at all. It's actually found in the structural plumbing that was just quietly installed beneath the financial system.
Right.
But to truly appreciate how strong that new foundation is, we have to look at the sheer scale of the macro shock that the market is currently just shrugging off.
The narrative whiplash over the last 24 hours has been insane. We went from the relief of a massive diplomatic resolution to watching the entire region just catch fire again.
Yeah.
Everyone was pricing in the Islamabad Accord, the U.S.-Iran ceasefire brokered by Pakistan, and then literally overnight it completely shattered. How did a deal that was supposed to stabilize the global economy fall apart so quickly?
The failure basically came down to a catastrophic dispute over geography. The primary actors fundamentally disagreed on what the ceasefire actually covered.
Wait, they didn't agree on the borders of the ceasefire?
Precisely. The United States and Israel operated under the strict interpretation that the truce explicitly excluded the Lebanese theater.
Okay.
France and the Pakistani mediation team, however, believe Lebanon was fully protected under the agreement.
Mm-hmm.
So when you have a geographic misalignment of that magnitude, the legal foundation of the treaty is functionally obsolete.
Wow. And that diplomatic collapse gave the Israeli military the strategic window to launch what they're calling Operation Eternal Darkness. And the sheer volume of the kinetic action is terrifying. It wasn't like a slow escalation at all.
No, it was overwhelmingly rapid.
Yeah.
I mean, we were talking about 100 targeted strikes executed in a highly compressed 10-minute window.
100 strikes in 10 minutes.
Yeah, exactly. It systematically targeted infrastructure across the eastern Bekaa Valley and southern Lebanon, but it also heavily impacted densely populated civilian sectors of central Beirut.
Which is just horrific.
The confirmed numbers are severe 254 casualties with over 1,000 wounded. Furthermore, an Italian UNIFIL peacekeeping convoy actually took direct fire during the operation.
Oh, wow. So that involves NATO.
Right, which is currently generating massive diplomatic outrage across NATO-aligned nations.
The localized tragedy is horrific, but the immediate downstream consequence is what actually hit the global markets. The Iranian executive apparatus essentially declared the ceasefire null and void and just went straight for the world's economic jugular.
Yeah, they abandoned their commitments to safeguard international shipping and actually deployed sea mines right in the Strait of Hormuz.
We even have verified tracking data of the Aurora, that's a U.S. Treasury sanction, Panama-flagged oil tanker, executing a literal emergency 180-degree retreat right at the Strait's exit just to flee back into the Persian Gulf. So commercial transit is just entirely halted.
Right, and choking off the Strait of Hormuz removes roughly a fifth of global petroleum consumption and a quarter of all seaborne liquid natural gas from the market. I mean, this weaponizes global inflation almost instantaneously.
Okay, let's unpack this for a second. If we look at the basic financial gravity here, shutting down 20% of the oil supply means everything costs more to make and move. Doesn't that guarantee a massive inflation spike and force the Federal Reserve into a corner? They can't lower interest rates if inflation is spiking, right?
That is the exact mathematical trap central banks find themselves in today. When the supply of crude oil is artificially constrained like this, energy benchmarks surge.
Right.
And that bleeds into industrial manufacturing, shipping, agriculture, you name it.
Yeah.
The Federal Reserve measures this through a metric called the PCE, the Personal Consumption Expenditures Index.
The Fed's ultimate thermometer.
Exactly. Think of the PCE as their thermometer. When that thermometer runs hot due to a geopolitical supply shock, central bank governors are legally paralyzed. They cannot cut the terminal interest rate to rescue the markets.
So they're trapped in a higher for longer posture.
Yes. And for a non-yielding asset like Bitcoin, which historically thrives when global fiat liquidity is expanding, a restrictive monetary policy is structurally oppressive. It should just starve the ecosystem of capital.
And that is the massive contradiction we are dealing with today. Because if the Fed is paralyzed and liquidity is drying up, a speculative asset should be in a total nosedive right now.
It absolutely should be.
And if we look at the psychological metrics, the broader market is terrified. The fear and greed index is sitting at 14, which is categorized as extreme fear. And we know the legacy financial system reacted to that fear, like money rush out the door.
Oh, we saw immediate, targeted de-risking by early institutional entrants.
Yeah.
Over the last trading session, U.S. spot Bitcoin ETFs bled an aggregate net outflow of $124.5 million.
Yeah.
Fidelity's fund alone lost $79 million, and ARK saw $75 million exit. Institutional managers looked at the C-mines, looked at the inflation models, and just executed their profit-taking protocols.
Here's where it gets really interesting, though. Despite that massive capital flight, the price barely moved. It dropped from an optimistic intraday peak of 72,865 when the ceasefire was announced to a baseline of 71,247 today.
Right.
That is a microscopic 73 basis point decline. The asset basically built a fortress around the 70,000 mark. The math simply shouldn't work. How is the spot price holding so incredibly steady when the legacy ETF investors are actively pulling over $100 million out of the market?
Well, the microstructural order books are actively overriding the short-term algorithmic panic. The sell pressure is being neutralized in real time.
So instead of thinking of this market like a house surviving a Category 5 hurricane without a single broken window, think of it like a massive sponge that just got dropped into the ocean.
I like that analogy.
The retail investors and early ETF buyers are the waves splashing on the surface, loud, visible, volatile. But beneath the surface, there are these deep currents slowly saturating the sponge from the bottom up. They are quietly absorbing that sell pressure so efficiently that the surface barely ripples. What exactly is making up that deep current?
The absorption is coming from two tectonic regulatory and institutional shifts in the United States that just went live. The first involves Morgan Stanley.
Okay.
While legacy ETF participants were panic selling, a brand new pipe of institutional capital just turned on. The Morgan Stanley Bitcoin Trust, or MSBT, officially commenced trading on the NYSE Arca exchange on April 8th.
There are plenty of asset managers launching funds, but this feels entirely different.
It is fundamentally different. This is the first time a Tier 1 U.S. commercial bank has transitioned from merely facilitating third-party access to actively issuing its own proprietary spot vehicle.
Right.
They launched directly into a deteriorating macroeconomic tape played by kinetic warfare. Yet MSBT absorbed $30.6 million in day one net inflows. They immediately captured over 444 physical Bitcoin right off the market.
Wow. They came in second only to BlackRock on day one. But the real leverage here isn't just the initial $30 million, is it? It's the fee structure they deliberately engineered.
Absolutely.
Morgan Stanley set an aggressively low annual management fee of 0.14%. That intentionally undercuts the market leaders like BlackRock and Fidelity, who charge 0.25%.
Yeah, 11 basis points might seem negligible to a retail trader, but for corporate treasurers or wealth managers deploying tranches of $10 million or more, that fee arbitrage translates to highly material annual savings.
Oh, for sure.
It mathematically forces fiduciaries to justify why they would pay more for a competitor's product. However, the true macroeconomic threat, the real reason the spot price is refusing to break lies within Morgan Stanley's proprietary distribution architecture.
Right, because launching an in-house product unlocks their internal army of advisors. We are talking about 16,000 wealth management advisors who collectively oversee between $6.2 trillion and $8 trillion in client capital.
Historically, if a Morgan Stanley advisor wanted to recommend a third-party ETF to you, they faced structural conflicts of interest, revenue-sharing disputes, and massive internal compliance friction.
The bank didn't want capital leaving its ecosystem.
Exactly. Now, those advisors are actively incentivized to allocate your capital directly into MSBT because the management fees remain sequestered entirely within the institution.
And their internal guidance already permits allocations of up to 4% of a client's portfolio into crypto assets. I mean, if even a tiny fraction of that $8 trillion begins moving into MSBT, it creates a persistent, sticky bid.
Right. It continuously drains available supply from the secondary market. The localized order books now possess the density required to absorb those macroeconomic shocks.
So the $124 million in panic selling from the other ETFs was simply swallowed by this new internal demand.
Yep. But Morgan Stanley's wirehouse wealth is actually only half of the structural equation protecting the market today.
The second massive shift happened on the regulatory side, targeting the retirement market. If you've ever tried to rebalance your own 401k, you know how restrictive those investment menus are.
Oh, very.
You typically get a handful of target date funds and some basic index trackers, but the U.S. Department of Labor just moved to change that entirely.
Yeah. Acting on a mandate from Executive Order 12330, the Employee Benefits Security Administration formally proposed a structural regulatory adjustment to democratize access to alternative assets.
Right.
They constructed a legal safe harbor for planned fiduciaries, evaluating alternative investments, explicitly including digital assets, for defined contribution plans.
We really need to explain why employers have been so terrified to offer crypto in a 401k.
Yeah.
It wasn't necessarily a philosophical objection to the technology, was it?
No, not at all. It was the fear of lawsuits under ERISA law. If an employer put a volatile asset on the menu and the asset's price dropped, the employees could literally sue the plan administrators for breaching their fiduciary duty. Because of that severe litigation risk, only 4% of defined contribution plans currently offer any alternative investments at all.
But the Department of Labor's new framework systematically dismantles that legal friction.
Exactly. The proposal states that if fiduciaries objectively evaluate 6 specific parameters, performance, fees, liquidity, valuation, benchmarking, and complexity, they are granted a legal safe harbor. It completely shields them from that undue fear of litigation.
So what does this all mean? It sounds like the Department of Labor just took a massive legal dam that was blocking trillions of dollars out of fear of lawsuits and completely blew it wide open.
That's a perfect way to put it. They officially engineered the regulatory pipeline required to unlock the $10.1 trillion 401k defined contribution market.
$10 trillion?
Yeah. When you combine Morgan Stanley's $8 trillion in wirehouse wealth with the Department of Labor unlocking $10 trillion in retirement capital, you introduce a permanent structural tailwind. It fundamentally rewires the supply and demand dynamics, neutralizing episodic retail panic.
And it isn't just the institutional fiat pipelines upgrading. The actual technical trading infrastructure is adapting to stop people from hitting the sell button.
Right. The underlying derivatives architecture has evolved rapidly to provide sophisticated actors with alternatives to liquidation. For example, Binance, the largest digital asset exchange, just executed structural upgrades to its VIP loan service.
Wait, how does a loan service stop the price of an asset from dropping?
By entirely removing the need to sell.
Ah, okay.
The Binance upgrade allows institutional users to pledge diverse asset types as collateral for a single fixed-rate loan. If a hedge fund or corporate treasury needs emergency fiat cash to hedge against the geopolitical shock in the Middle East, they don't have to dump their crypto on the open market and crash the spot price.
They simply borrow against it.
Exactly.
Yeah.
It traps the sell pressure off-screen.
We are also seeing OKX announce the listing of USDT margin perpetual futures for the UNITES protocol. They are expanding synthetic liquidity, allowing participants to utilize up to 20x leverage.
The continuous expansion of high-leverage perpetual contracts and advanced lending facilities deepens the overall financialization of the sector.
Right.
Market makers are actively constructing synthetic liquidity. When institutions need capital, they simply hedge their positions synthetically rather than abandoning their spot assets.
All of this invisible plumbing creates an incredibly resilient market. The foundational support is robust. But we also have to recognize that the market is trapped in a pressure cooker right now.
Oh, definitely.
The plumbing is installed, but the immediate trajectory of the price over the next few days hinges on a massive binary event.
Right, because while fiduciaries must decouple their long-term strategies from short-term headlines, the immediate spot valuation is waiting on diplomatic negotiations.
Emergency bilateral negotiations are scheduled to begin in Islamabad on Friday. The United States is dispatching a high-level delegation led by Vice President J.D. Vance to engage directly with Iranian Foreign Minister Abbas Araqi.
This is the event that quantitative risk managers are modeling right now. There are essentially 2 paths forward.
Let me make sure I'm getting this right. You're saying the long-term plumbing for massive wealth is fully installed, but the next 72 hours of price action basically comes down to a coin toss at a single negotiating table in Pakistan.
For the immediate spot valuation, yes.
Okay.
If the Vansarati negotiations collapse, perhaps because Iran demands maritime transit tolls or tries to link the ceasefire back to the Lebanese theater, the Strait of Hormuz blockade will solidify.
Which means oil prices stay high.
Right. The resulting surge in Brent crude oil will mathematically force the Federal Reserve to maintain its restrictive monetary posture.
Yeah.
In that scenario, algorithmic trading engines could violently drag the spot valuation of Bitcoin down to test the 60,000 threshold.
But if they reach an agreement, the opposite reaction will be explosive.
Exactly. If the Islamabad summit yields a ratified, comprehensive de-escalation framework that successfully clears the maritime choke point, the macroeconomic risk premium evaporates instantly.
The fear of a massive inflation spike just disappears. And the moment that macro fear evaporates, the structural powder keg we just spent the last 15 minutes exploring, Morgan Stanley's 16,000 advisors, and the newly proposed Department of Labor 401k safe harbor ignites.
Fiduciaries will scramble to secure pristine collateral in a legally sanitized environment. The spot valuation would likely drive aggressively back through overhead resistance nodes. But, the structural reality is already set, regardless of Friday's outcome.
It's just the timeline of that capital deployment that is highly dependent on the success of this summit.
Exactly.
It is a truly bizarre reality to decode today. We are looking at a market suspended entirely between two opposing forces. You have the deflationary terror of a fracturing global energy matrix and a kinetic war in the Middle East.
Yeah.
And directly countering that, you have the inflationary certainty of legacy wealth finally unlocking the 401k and wirehouse markets.
It really requires a rigorous adherence to risk management. You cannot simply look at a headline about a collapsed ceasefire and assume the market will behave the way it did 5 years ago.
No, not at all.
The mechanics have fundamentally evolved.
That is the most crucial takeaway for you listening today. When you see terrifying headlines, when you hear that the Strait of Hormuz is mined and you logically expect your portfolio to crash, remember that beneath the surface, the market's plumbing is undergoing a massive stabilizing upgrade.
Yep. The legacy wealth integration is acting as a literal shock absorber for geopolitical contagion.
The panic selling on the surface is being absorbed by a very quiet, very deep pool of institutional capital that is just starting to flow. You have to understand the microstructural reality beneath the news cycle. The law of gravity in finance seems to have been completely suspended.
It really does.
A major conflict is choking off a massive portion of the global oil supply, yet the digital asset market is holding a fortress at 70,000. It leaves you with a profound thought to chew on.
What's that?
If a literal war-driven global energy crisis can no longer force a total crypto market capitulation, are we witnessing the exact moment where digital assets stop behaving like volatile tech experiments and officially transition into foundational anchors of legacy wealth?
It's a paradigm shift that changes the calculus for every single allocator on Wall Street.
Something to keep in mind as we watch those negotiations in Islamabad unfold. Thanks for joining us on this deep dive.